All right, let's jump right into this explainer. Today, we're unpacking the SASB standards for tracking and disclosing the financial impacts of discriminatory lending in the mortgage finance sector. If you follow the financial industry, you already know that sustainability reporting has evolved way beyond just tracking environmental footprints. Today, we're looking at a highly specific, highly consequential metric that bridges the gap between social responsibility and hard, quantifiable financial data.
Here's our roadmap for today. We'll start with a quick intro to SASB standards, look at the big risks in mortgage finance, zero in on the specific risk of discriminatory lending, figure out exactly how to track those legal monetary losses, and finally, wrap up with how to disclose the context and corrections. Let's get into it.
Part 1. Introduction to SASB standards. So when investors want to evaluate sustainability risks, they turn to a globally recognized framework. Now, as of August 2022, the International Sustainability Standards Board, or the ISSB, actually took over stewardship of the SASB standards. And you know what that means? It means tracking these sustainability-related risks isn't just some fringe, nice-to-have practice anymore. It is a core, absolutely crucial piece of financial reporting. It's explicitly designed to spotlight factors that could realistically mess with a company's cash flows, its ability to get financing, or its overall cost of capital down the road.
But before we get into the weeds on the specific risks, we really need to remember what the mortgage finance industry is all about at its core. It provides a massive public good. These entities are lending out capital using property as collateral, right? Which means they are literally the engine enabling people to buy homes and boosting overall homeownership rates. But because this industry is so deeply baked into our collective financial well-being, it operates under incredibly intense scrutiny and some seriously complex regulatory frameworks. It's a high-stakes environment.
Which brings us to Part 2, Risks in Mortgage Finance.
If you think back to the 2008 global financial crisis, we all remember that, right? The regulatory landscape shifted massively after that. Regulators doubled down hard on consumer protection, pushing for way more disclosure and strict accountability. And this wasn't just a flash in the pan. It permanently aligned what's good for society with what's good for long-term investors. Investors look at this and say, okay, if a mortgage lender fails to protect its consumers, that's not just a PR problem. That translates directly into severe financial and operational risk for the bottom line.
Moving right along to Part 3, the discriminatory lending risk.
If you take a look at the SASB standards, discriminatory lending isn't buried in the footnotes. It is explicitly categorized as a core sustainability disclosure topic. It's sitting right up there next to huge environmental risks like lending in 100-year flood zones and general lending practices. The very fact that discriminatory lending has its own dedicated accounting metric, that tells you exactly how seriously the financial community takes this specific risk.
Think about how mortgages are made. The origination process crunches a mountain of data to figure out loan size, interest rates, upfront points, the whole shebang. Because it's so complex, there is a very real risk of discriminatory lending practices creeping in, whether that's totally intentional or completely by accident. And the fallout from that, it's huge. We're talking massive regulatory fines, brutal reputational damage, and taking a major financial hit because loans were priced wrong. To prevent this, institutions absolutely have to have proactive monitoring and ironclad internal controls.
So how do they monitor it? First off, entities have to track baseline demographic data. They use a specific structure to categorize loans between minority borrowers and all other borrowers. They track the number of loans, the total dollar value, and the weighted average loan-to-value ratio for each group. And just as a quick aside, the standard uses the UN Office of the High Commissioner for Human Rights definition of minority to keep this baseline consistent globally. But tracking loans is just step one. What happens when the system fails and things actually go wrong?
That's what we're going to cover in Part 4, Tracking Legal Monetary Losses.
This brings us to the multi-million-dollar question. Let's say a company faces allegations or outright findings that they discriminated in their lending practices. How exactly is that financial fallout quantified for investors in a way that's actually standardized and useful?
Well, the SASB standard gives us a laser-focused metric for this exact scenario. Code FNMF270B.2. This metric requires companies to disclose the total amount of monetary losses they took during the reporting period specifically because of legal proceedings tied to actual or even alleged discriminatory mortgage lending. It's a hard, strictly quantitative number reported right in the entity's presentation currency.
And let me tell you, the scope of what counts as a legal proceeding and a monetary loss here is incredibly broad. We're talking about any adjudicative proceeding, court, regulator, arbitrator, doesn't matter. If there's a monetary liability paid out to an opposing party or anyone else, it goes in the bucket.
That means pulling together everything: civil judgments, out-of-court settlements, regulatory penalties, disgorgement, restitution, even criminal judgments and penalties brought by governments, businesses, or individuals. All of it gets tallied up.
But, and this is a really vital distinction you need to catch, while all those penalties and settlements have to be included, the metric strictly mandates that companies exclude their own legal defense fees. Why exclude those expenses? Because the goal here is to give investors a crystal clear, pure measurement of the actual penal or settlement cost of the discriminatory practice itself. They don't want that number muddied up by variable attorney hourly rates or defensive litigation costs. It's entirely about the cost of the offense, not the defense.
Let's move to Part 5, Disclosing Context and Corrections.
Just tossing a big scary financial number on a report isn't really enough. Under the technical protocols for this metric, entities have to complete two crucial follow-up steps. Step 1, they need to give a brief rundown of the exact nature and context of the loss. Was it a settlement, a guilty plea? And what was the underlying context? Was it an issue with employee compensation structures or something else? Give us the details. Step 2, they absolutely must describe the specific corrective actions they actually implemented in response to those legal proceedings.
The SASB standard actually provides a list of areas where these corrective actions usually happen, and it's a wide range. It could be retraining staff, updating their underwriting tech, completely overhauling their internal ops, tweaking the actual loan products themselves, or even firing business partners and changing management structures. The whole point here is that investors aren't just looking at a financial loss. They are being handed a roadmap showing exactly how the institution is adapting its internal controls to make sure this never happens again.
So, looking at the big picture, by forcing this highly transparent, standardized accounting of both the financial penalties and the corrective actions, we have to ask a bigger question. How will this framework ultimately reshape the future of fair lending? Because when monetary losses from discrimination are tracked this meticulously, out in the open, it absolutely elevates fair lending from just a simple compliance checkbox into a make-or-break measure of an institution's long-term survival.